Good evening, and thank you for joining us today. The topic that we're going to discuss tonight is spreading one bet. On behalf of the team at MYTHEO, we would like to welcome you to the webinar. My name is Simon. Before we start, a quick introduction of MYTHEO. MYTHEO is an extension of THEO, the first and the #1 robo-advisor in Japan. We are awarded the Digital Investment Management License by the Securities Commission Malaysia in 2019. For anyone who wants to protect and grow their personal savings to achieve long-term goals, MYTHEO is a simple and accessible investment solution that provides low-cost, institutional quality portfolio tailored to each individual's risk profile. MYTHEO offers low-cost, low minimum, and more convenient compared to other investment alternatives. The simplicity of MYTHEO mobile apps provides a better user experience, while MYTHEO investment process recommends and implement a superior portfolio, plus will regularly rebalance your portfolio so you don't have to do it yourself. A quick rundown of our 1-hour session today. It will be carried out in a Q&A format with live polls in between. Meanwhile, if at any time during the webinar you would like to ask the speaker any question, we encourage you to interact with us via the Q&A button. The webinar will be recorded and you can play back the recording from our YouTube page. I'm joined by Matthew Stuart-Box, the Chief Investment Officer of MYTHEO and Chief Operating Officer of THEO. He has been in the investment industry for more than 20 years. He joined us today from Tokyo to share his thought on the importance of diversification in your investment portfolio for a more stable and potentially higher returns while also taking lesser risks. Hi, Matt. Thank you for taking the time to join us.
Thank you, Simon.
Okay. If I can start with the first question. Diversification is something probably every investor has heard of, but a topic that has a lot of different definitions depending on who you ask. To get us started, how do you define diversification, and why do we need to diversify our investment portfolio?
Thank you, Simon. Yeah, no, this is a great topic, and it's one that's very relevant right now. I think we're seeing, given the market volatility, in many ways, the value of diversification. Maybe if we start here, there's a lot of definitions of diversification. I picked out a few at random from various different asset managers and investment sites online. And they all have slightly different wording, but if you read them, you can see that the key element that comes up in all of these definitions of diversification is risk. And so you see here, it talks about a risk management strategy. Here it talks about managing risk, reducing the volatility, Again, volatility is just another word for risk, reducing your overall investment risk. So what they're really getting at in these kind of definitions is that diversification is a strategy that you can use in your portfolio to try and reduce the overall risk of your portfolio. We'll come back to this definition in a minute, because I think it's these definitions they're not bad, but they're missing something very important. But we'll come back to these. If we think a little bit about how, in theory, diversification works, it works because not all assets move together. Different asset classes, different markets, different securities move obviously in different ways. The table we have over here is a very common table showing the correlation between various different asset classes. And so the different cells on here represent different asset classes, different forms of equities, different types of US bonds, foreign bonds, government bonds, real estate, commodities, those kind of things. And the numbers on here represent the correlation between each pair of assets. And so obviously a score of 1 here means the assets move exactly together.
Mm-hmm.
And so the cross terms on here are all 1 because they're comparing each asset with itself. And a number less than 1 means they don't move completely together.
Mm-hmm.
And so you can see, in general, things don't move together. There are groups of assets that move quite highly together. Here we see a bunch of equity assets that have relatively high correlations, 0.8, 0.87. But other things have very low correlations with them. If we look here, we can see these are various bonds that have a very low, or in some cases even a negative correlation with equities. And this is what diversification is using. The fact that these assets don't all move in the same direction at the same time.
Mm-hmm.
And so by combining different assets together, you can net out some of these movements and lower the overall risk of your portfolio. Sure. That's the basic mechanism that's behind diversification. Sure. If you also look up diversification, you'll often see a graph like this. And this is the idea that while there are some risks that you can get rid of by diversification, technically we call these unsystematic risks. These are risks that relate to individual markets or individual securities, individual companies. These things can be diversified away by taking a range of different assets. But you'll never get your risk all the way down to 0. And there'll always be an element of risk that, because you're investing and investing has inherently some uncertainty behind it, there'll always be a level of risk that you cannot diversify away. There's different names for this. Some people call this market risk. Other people call this systematic risk.
Mm-hmm.
There's an element of risk that no amount of diversification will be able to get rid of.
Sure.
So the key points behind diversification is you're investing in a range of different securities or assets.
Mm-hmm.
You aim to reduce portfolio risk, but this is the point that I think is missing from those definitions.
Mm-hmm.
You're not just trying to reduce your risk, you're trying to reduce your risk while you meet your investment goals.
Mm-hmm.
And this is a very important point. The game here is not simply to reduce your risk as much as possible. If you want to reduce your risk as much as possible, just hold cash. That has 0 risk.
Yep.
But that won't meet your investment goals. And so the important point about diversification is meeting your investment goals with the lowest possible risk. That's the goal of diversification. And lower correlation helps you with this.
Yep.
But as I said, you can't eliminate risk completely. So what you're aiming to do is take the level of risk that's best for you and take that risk where you think you'll get rewarded, where you think you'll get returns. In other words, take the right amount of risk in the right places to meet your investment goals. That's how I think of diversification.
Sure. Thanks for sharing this. Well, the aim obviously is in this kind of market circumstances, is not to stay out of the market, right? Is to basically take a more manageable risk in order to achieve our investment goals. So diversification definitely is something that I think I will be looking forward to learn from you. Well, for the audience, I'm launching the first poll. So if I can get your participation, are you currently looking for new ways to diversify your portfolio? Yeah, we have 4 answers there. Yes, no, not, but expect too soon. Don't know. Yeah, if you can just tell us, your way forward. Okay. Now let me share the result. Okay, so most of our investors here say that no, we are not looking for new ways to diversify portfolio. Not so soon. Well, we do have some people that say yes, we wanted to look for ways to diversify our portfolio. So, so I think what matters is when it comes to diversification, how, or what type of investment that investor should consider?
Sure, yeah. I mean, there's different ways of answering this. Maybe I can explain a little bit about how we think of it. So the way I think of diversification is there's kind of three kind of levels of diversification going on. The first, the kind of the obvious one, is diversification across different regions, different countries, things like that. If you have all of your assets, say in the UK, then if for some reason the UK economy does poorly, then it's likely that your investments will also do poorly. And so one way of diversification is taking your assets and don't just invest in the UK, invest some in the US, some in France and Germany, and some in Asia, and in many different countries as you can. By doing that, you'll reduce the chance of you being hit by poor economic performance in one particular country. So that's a very common form of diversification across different countries, different regions around the world. Another way of thinking of diversification is across different assets, different asset classes. And so obviously most people would invest in equities, stocks, but also, you could diversify into bonds. We saw earlier on that correlation matrix that often bonds have a very low or sometimes even a negative correlation with stocks. So they have a very good diversification benefit. But also more broadly, there are other asset classes, things like real estate, commodities, various different commodities, precious metals, oil, agricultural commodities, all of which have correlations that are less than one. Also, perhaps currencies as well could be an asset class that we want to diversify into.
Sure.
So by spreading your bets, not just across different regions, but across different types of assets as well, you can reduce the risk that a particular asset class does badly, or a particular combination of asset classes does badly. That's another way. And then the third way is also very important, but diversification across time. And this may be a little harder to explain, but the idea is, if you think about your return on your portfolio, you can think of it as depending on two things. One, the price at which you sell your asset, but also, of course, the price at which you bought that asset. And it's those two things that determine the return, obviously, of your investment. And if you go and invest all of your assets at one point in time, there's obviously the risk that the price at which you buy those assets will be relatively high. It could be that markets are at a peak at that point in time. You won't know that at the time, you'll only know that afterwards. But if you invest all of your money at one point in time, there is a risk that you'll end up buying at the top of the market. And then when you come to sell, you'll be sitting on perhaps a loss or a very, very small gain. Asset prices move all the time, and there's no way of knowing in advance whether you're at a peak or a trough. So a very good way of lowering your overall risk is to invest bit by bit into your portfolio. A lot of people do this monthly. They set up, a regular monthly amount to invest. Every month on the same day, they invest a set amount of money into their portfolio. And that lowers the risk of you buying at the peak. So that's another way, I think, of thinking about diversification. And these combination of across regions, across assets, across time, can help to lower the overall risk of your portfolio while keeping the necessary return.
Sure. Seems like there's a lot to do in terms of diversification, not just in terms of different regions, different countries, different assets, but also different intervals. So is there a particular mistake you see average investor make in regards to diversification within their own portfolios? Sure,
yeah. There's been quite a lot of research, on the kind of biases that individual investors have in their portfolios. These are quite well documented. I think there's maybe 3 or 4 that are very common. One is a kind of a personal bias.
Yeah.
A lot of people talk of something called the home country bias. And that tends to be, it's natural, I think, when you start investing, to invest in things that you are familiar with. And that naturally might be investing in assets in the country in which you live. Some people, it means investing in the industry where you work, perhaps even maybe the shares of the company where you work.
Yep.
And that's a very natural kind of thing. When you're starting investing, there's a lot of risk involved. So you want to start perhaps with something that you know, or something that you're familiar with. And there's nothing particularly wrong about that. But if you stay with that home country bias, or that bias towards a certain industry or a certain company, then you're going to miss a lot of diversification benefits. And this is a very common problem of, I think, individual investors in any country. They tend to be overweight their own home country.
Yep.
That's one common mistake. A second common mistake is overconfidence. When people have maybe a little bit of experience investing, they start to read a bit and start to understand how markets work, have their own views about how the economy is going and things like that. There's nothing wrong with that. It's very natural, especially if your portfolio does well for a while. It's very natural for people to become overconfident. They think they know how to do this. They know which way the market is going. And the problem there is it does tend to lead to portfolios that tend to be quite concentrated. Naturally, if you have a high level of confidence in which markets or which sectors you think are going to do well, then naturally you're going to want to concentrate your portfolio into those sectors or into those markets. Again, there's nothing naturally wrong with that. The problem is it's extremely difficult to predict which market is going to do well, which sector is going to do well. And so this over-concentration of portfolios often hurts, I think, individual investors. Maybe the flip side of this, and you often see these kind of comments in investor blogs, things like that, this concept of over-diversification. Diversifying too much is bad for your portfolio. And they often phrase it in terms of, diversification diluting your returns, or giving you a portfolio that is overcomplicated. And I understand those fears, and I think there is an element of truth to those. But I think that the problem here comes from this bad definition of diversification. If you only think of diversification as lowering your risk to the lowest possible level, then I think you may end up with these kind of problems. But as I said, that's not really a very good definition of diversification. The real definition you want to use is lowering your risk while achieving your investment objectives. And so that means maintaining the expected return for your portfolio, making sure that you've got the right long-run return, the right long-run return profile in your portfolio. And then given that, trying to take as little risk as possible. That, I think, would avoid these kind of concerns over diversification. Then finally, I'd say, and a common mistake, especially of retail investors, individual investors, is misunderstanding just how much risk you can tolerate. Often people will say, I'm quite happy to take a lot of risk. I'm quite happy to take a high amount of risk, and I want to aim for high returns. Therefore, I want a high-risk portfolio. Therefore, I want, for example, a concentrated portfolio. And in my experience, saying that you want a high risk level is very, very different from actually experiencing high risk. I've been investing for, as you said, well over 20 years.
Mm-hmm.
I've lived through things like, obviously, the Lehman shock,
Yep.
various China shocks, going back even further, things like the bursting of the IT bubble back in the early 2000s. And those are cases where, equity markets can fall 40%, 50% or more in a relatively short period of time.
Yep.
And afterwards, when you look at the graph, it doesn't look so bad. You can see that it comes back. But in the middle of an event like that, in the middle of the Lehman shock, or in the middle of the bursting of the IT bubble, you can't see the bottom. It looks like the market is going to go down forever. And in those kind of situations, it's very easy to make the wrong decision and cut risk, reduce your exposure, shift to cash. Even though you may think you have a high risk tolerance, actually living through a downturn like that can lead to some very bad decisions. And that can lead to you, missing out on the rebound, that kind of thing. And so I think that's probably another common mistake that individual investors often make.
Sure, thanks. So, well, diversification, although the concept is pretty straightforward, but do it is not easy, actually. Looking at, human are so emotional, right? So we could actually stumble to this common mistakes. So before we proceed to the next question and understand how MYTHEO can actually help investors to create a diversified portfolio, let's just go through this poll. How do you feel about the following statement? Automation and digitization of investment management have revolutionized the market in terms of the transparency around different asset classes and the investment strategies that can be developed. You can choose, you agree, fully agree, partially agree, or do not agree. Okay. Thank you for your participation. Let me share the results. So most of all our participants here agree to a certain extent. Some of them partially agree, and some of them fully agree. So I think next question is that MYTHEO, we do a lot of portfolio construction for investors, right? And we do help investors to avoid pitfall like what you have mentioned here. So if you can share, how do MYTHEO create a portfolio that can mitigate some of those risks, but still capture return to achieve the investor's investment objective?
Sure. Yeah, I can maybe explain a little bit about how we approach portfolio construction and where diversification fits in MYTHEO. This is a slide we often use to explain, how MYTHEO works. So I'll maybe just briefly explain this, and then we'll get into the details of how that fits in with diversification. And so the key idea here is we're using a automated process, investment algorithms that we built in order to build a portfolio that meets the needs of the individual investor. And so the way we approach that is we first off, we find out a little bit about the investor. We ask 5 very simple questions of the investor, things like their age, their income, their assets, how long they want to invest, that kind of thing. They're very, very simple questions. And then based on that, we generate a portfolio that's made up of 3 different parts. And the idea here is that people don't invest just for a single reason. There's various different reasons why people want to invest. And we need to build portfolios that reflect those different reasons. And the way we think about it is, basically 3 reasons to invest. One is for growth, to grow the size of your assets over the long run. Naturally, this means taking a relatively high amount of risk, aiming for high returns over the long run. That's perhaps, the most common form of investment objective. Many people have that. And so we have an element of our portfolio that's focused on delivering that. There are other reasons why people might want to invest. The other part we can think of is, some people would want to invest in order to generate regular income, a regular income stream. Perhaps people who are reaching retirement, they want an income stream that is going to fund their living expenses, things like that. That's a perfectly valid reason to want to invest. So we have a portfolio that's dedicated to providing that kind of investment stream. So that takes lower investment risk and aims to generate a more stable stream of returns for investors. So that's the income part of the portfolio. And then there's a third reason that people might invest, and that might be, if you've got some assets already, then one reason to invest might be to protect the real value of those assets, protect those assets from inflation. Obviously, if you kept your assets simply as cash in the bank, you might earn some interest, but certainly at the moment, that interest is unlikely to cover price rises. And so the real value of your assets would shrink. And so we have a portfolio that's dedicated to trying to at least match inflation in the long run. Inflation in the long run. And that's another perfectly valid reason for wanting to invest. So what MYTHEO does is, based on the answers to those questions, it tries to assess each individual investor's needs for growth, income, and inflation hedge, and then decide an allocation across these three different portfolios. And that allocation would be different for each investor, hundreds of different potential combinations. And then we'll go out and build your portfolio to match that allocation. And then every month we'll keep rebalancing it, optimizing it, and making sure it stays at the ideal allocation for that client. So you can see, at one level, we talked about diversification across investment classes. Well, this is where you're getting it within MYTHEO. Essentially three very different asset classes that you're invested across. So you get one level of diversification immediately right here.
So I noticed basically there are three different portfolios, which means if you can share with us how many asset classes will an investor get? And well, naturally, I think investor would have built a portfolio which consists of the equity and bond. And is it important to go beyond that, beyond these two traditional asset classes?
Sure. Yeah. That's the answer is yes. It is very important to go beyond that. Maybe if I explain a little bit more about what's in each of these portfolios. And so this growth portfolio, as I said, is aiming for long-term growth in the value of your assets. And so naturally, this growth portfolio is focused on equities. And so this growth portfolio invests in a group of global equity ETFs spread around the world. Almost every market in the world is included in there somewhere. Developed markets, emerging markets, every major region of the world. They're all equities. This income part of the portfolio, as I said, the goal here is to generate a stable stream of income, a stable stream of returns. And so naturally, this income portfolio is mostly built from bond ETFs. But again, there's a big range of different ETFs in here. There are, government bonds, corporate bonds, high yield bonds, US bonds, non-US bonds, a whole range of different bond instruments. we can invest in.
Yep.
So that's kind of the equities and bonds that you were referring to. The other asset classes are mostly down here in the inflation hedge. And if you think here, if the goal is to match inflation, in the long run, one of the best ways to do that is to invest into real assets, real physical assets. And so this inflation hedge portfolio is focused on things like real estate, so ETFs that invest into real estate, things like precious metals, gold and silver, and then a whole bunch of commodities, things like oil, agricultural commodities, industrial metals, things like that. And so these kind of assets can give you a lot of diversification relative to equities and bonds, obviously because the underlying drivers of, for example, something like gold are very different from the underlying drivers of, say, equities or government bonds.
Sure. Well, there's a question from our audience. What fallacies or unpredictables could MYTHEO be facing with the methodology or strategy implemented?
Yeah, sure. So I think that's a very good question. I would say maybe the biggest issue that, or the biggest potential problem that a strategy like MYTHEO would suffer, and this is maybe true of most algorithmic or model-driven portfolios, is these are based off data. They're based almost entirely off historical data. We're not trying to predict which market is going to do well this year. We're not trying to predict which asset class is going to outperform this year. There are managers that try to do that, and that's perfectly okay. That's a very difficult thing to do, certainly very difficult to do consistently. MYTHEO is based mostly on historical data, and we use that data to build each of these individual portfolios to meet their targets with the lowest amount of risk possible. And so naturally, the biggest kind of risk to this kind of approach is that the future is very different from the past. These investment models are based on historical data, past data, and implicit in that is the assumption that the future, at least from a risk point of view, the future is going to look kind of similar to what it looked like in the past. And so if we had market events that are completely different, things that we've never seen in the past, completely new events, completely market movements that we've never seen before, then I think any quantitative model, including MYTHEO, would struggle. Having said that, we look back over 20 years in terms of historical data, and so this includes an awful lot of the kind of events I've mentioned before, very big market events like the Lehman shock or like the IT bubble, that kind of stuff. So those are included in our models, but I think the risk would be something completely different that has never been seen before. That would mean a lot of the assumptions, correlations that are built into a strategy like MYTHEO might not work.
Sure. Would it mean that the model will get smarter over time since it has sort of gone through more experience, and eventually it gets smarter, and then it could outsmart human as well, maybe?
That's true. As the data gradually accumulates, obviously, in that sense, the model gets smarter through time. Each month, it has another piece of data to add to its history. So in that sense, it does get smarter. The idea of it getting smarter than a human is perhaps, in my opinion, perhaps that's not quite the right way to think about it. It's more to do with avoiding the biases that humans have. That's more, those kind of biases are way more dangerous, I think, than whether you're smart or not smart. Because those biases are extremely difficult to avoid for a human. Sometimes you're not even aware of them. Even when you're aware of them, they're very difficult to avoid. And that, I think, is the value of a lot of these kind of models, is that they avoid those kind of biases. They avoid those kind of emotional responses to market movements. That's where I think a model such as MYTHEO can really add value.
Sure. And to build on that question, so how sustainable will this portfolio be, especially in bad times?
Yeah, sure. It's a very good point. I mean, there's a couple of things that I can do to mention. This is not a model that we've just built. We've been running this model with live money, live client money for over 6 years. And during that time, we've seen a lot of different kind of markets. Over the last 6 years, obviously we've had Corona, we've had various trade shocks between China
US
and the US. We've seen things like political shocks, things like Brexit, US, like Trump being elected in the US, a whole range of different geopolitical, economic shocks. And our models have worked well through those. Maybe a good way of answering the question, though, is perhaps looking at kind of in a longer horizon. These are the returns from our models simulated back all the way back to, in this case, 2007. So what, 15 years ago. And we can do this because they're all driven off data. So we just pull the data as of those dates, and we can simulate exactly what our portfolio would have been, returns it would have had. And so maybe if we look on the right-hand side here, we have the three different portfolios that I mentioned. The blue one here is the growth portfolio. So this is the equity part portfolio. It's the blue one here. The orange one here is the income portfolio. So this is the bond portfolio. And this kind of yellow one, this gray one is the inflation hedge. So these are the real assets, the real estate and the gold, that kind of thing. And then as a kind of indicator of the value of diversification, I've included this yellow line, which is just an equal weighted combination of those three portfolios. So just 1/3, 1/3, 1/3. Obviously, each individual investor will have a different ratio of allocation across these three portfolios. But for example, if you just take 1/3, 1/3, 1/3. And there's a couple of things that you can see straight off the bat. Number one is, like, in the long run, all three of these portfolios give you positive returns, which is a good thing. So, this is looking back over 15 years. Something like the income portfolio, it's gone from 1 to 2, so its value has doubled over the last 15 years. Something like the growth portfolio, which is looking for long-term returns, is more aggressive. This has gone up 200%. It's gone from 1 to 3, so it's gone up 200% over this period. So all of these returns, all of these portfolios in the long run give you positive returns. That's one thing. The other thing you can see is that, in particular, the growth portfolio, in order to get high returns, it has to take some risk. And so you can see here, in the first part of the period, this is the Lehman shock here, and it falls quite substantially here before gradually recovering. Whereas some of the other ones don't have anything like that kind of drawdown. So this shows it kind of in a graphical form. On this side, it shows more of a summary of kind of what the kind of returns and the drawdowns these different portfolios has. And I think this kind of demonstrates some of the resilience of this approach. So This has got the three different portfolios and then this equal weight. So we've got the annual return. So in the long run, this growth portfolio on average gives you 7.6% return, income 4.5%. So equal weight gives you this. And this is risk. This is just measured on standard deviation of the returns. The growth portfolio has a risk of 14, nearly 15%, 7 and 10. But when you combine them, you end up with a combined risk of 8.6. And so a lot of people use this Sharpe ratio, this ratio of risk to return, as a measure of how efficient your portfolio is. You can see that this equal weighted one gives you the highest risk return ratio at this combination. So from that point of view, you can see that from a kind of a portfolio efficiency point of view, this is working. A different way of thinking about it is looking at the actual drawdowns themselves, the biggest drawdowns over these periods. And obviously, the timing of the drawdown depends on the portfolio. But for example, the growth portfolio, this drawdown here, the Lehman drawdown here, is essentially a 50%, nearly a 50% drawdown here, and then a gradual recovery over the next 3 or 4 years. Obviously, the income portfolio has a lower drawdown, and the inflation hedge has a lower drawdown. You can see this weighted combination of these has a drawdown that's much better than, say, the growth portfolio. And equally, when you look at kind of the time it takes to recover, this is the number of months to kind of recover from the drawdown. The equal weighted portfolio is far better than, for example, portfolio. So there's no way that this element of diversification can eliminate risk or eliminate drawdowns completely. But this gives you a kind of an indication of how these, almost like say, portfolio could work in various different market situations.
In fact, you correctly pointed out, during bad times, it is a lot more sustainable. Like in the 2008 period, right, during the Lehman crisis, a client could lose half of the portfolio if, let's say, he's not diversified, right? So having 3 functional portfolios certainly helps to cushion the blow, because over long term, it does help to deliver better risk-adjusted return. So we have a question from an audience here. Investopedia defined dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. Would dollar cost averaging still works if the target assets are dynamic due to rebalancing of portfolios?
Yes, that's a very good question. Yes, that's exactly how Investopedia defines dollar cost averaging, and that definition I agree with. Yes, the answer to your question is yes, and the reason there is, say you do monthly rebalancing. What does that do? Well, each month it takes your portfolio and resets it back to the target allocation. Obviously, during the month, markets move. Some markets go up, some markets go down. And so your portfolio will gradually drift away from its target. And then each month, and MYTHEO does this, and lots of asset managers do this, each month you reset your portfolio back to your long-run target. And that's a very sensible thing to do for investment manager. What dollar cost averaging is trying to take advantage of is overall the value of your portfolio will move up and down through time, and that's regardless of whether you rebalance or not. Your portfolio will go up in value or will go down in value, and by doing dollar cost averaging, you'll be able to make sure that you invest at least part of your money when your portfolio is relatively cheap, part when it's a kind of an average level and part when it's quite high. And so dollar cost averaging can mean that you avoid investing all of your money right at the peak of your value of your portfolio. So yeah, Investopedia's definition is perfectly right. And it's perfectly valid even if you do regular rebalancing.
Yeah. Great. So, so it helps both to reduce the volatility via diversification and dollar cost averaging. Another question is, as there's no way to know when the next crisis will hit, what the digital investment manager like ourselves focus on when an investor decide to ask for our help to manage their savings?
Sure. I mean, that's a great question. Nobody knows when the next crisis is coming, and it's very easy, especially if you follow, newspaper comments, market comments, stuff like that, to get caught up in concerns about recent problems. And so the best example of that was right at the start of Corona, back in the first quarter of 2020. Markets were falling, countries were closing their borders. There's a huge amount of concern about what economic impact Corona might have. Markets fell sharply. Then over the last 9 months of 2020 recovered extremely strongly, and the US market was up over 20% on the year, and very few people would have been able to predict that, I think. So it's important to recognize that crises will come and go, but also that there'll be lots of false alarms as well. People worried about a potential crisis that doesn't turn out to be the case. But maybe I can talk a little bit about how we approach this kind of thing. And the point here is you can't predict these crises. That's the whole point of it being a crisis. If you could predict it, it wouldn't be a crisis. But what you can do is build your portfolio to be as resilient as possible. And this is this point we've been talking about for this session, is building a portfolio that's nicely diversified, but that does meet your investment needs. It's going to meet your investment objectives, including both of these things in your portfolio. And then keep your portfolio up to date. It is very important to rebalance your portfolio, re-optimize it, take into account the most recent market conditions, make sure that your portfolio is as up to date as possible. And then stay disciplined. We talked a little bit about this when we talked about the kind of biases and problems that individual investors have. One way to avoid those kind of human biases, emotional reactions, is to use a model-based approach, use algorithms to actually construct your portfolio. And then control your risks proactively through asset allocation across these 3 different portfolios, through the construction of your portfolio itself. And also, perhaps we don't have time today to discuss it. We do use a technique called AI Assist, an artificial intelligence program that we developed that aims to take a proactive approach to big market risks as well. The important thing here is you have a portfolio that's targeted at meeting your investment objectives, and given that, control the risks as much as possible. Finally, of course, we're talking about investing, so you've got to control your costs. A lot of people underestimate these. Obviously, the fees that you pay to your manager are obvious costs. Also trading costs, the costs of buying and selling, the costs of rebalancing your portfolio. If you're investing in ETFs, the underlying costs of the ETFs themselves. You've got to take those into account. Those are all coming out of your assets. They're all reducing your returns. And so controlling the costs is a very good way of giving your long-run returns an extra boost, I think.
Thanks for sharing this. I think the consistency is comforting to know that during the crisis, the digital manager will still remain consistent in terms of the approach and also to look at the cost side of things, as well as to proactively manage risk. Well, I do have this question. Well, there's another question from investor before that, if I can ask you. The model could be designed to be almost 100% emotionless. However, investors are always emotional and easily panic. What extent occurrence of panics redemptions since the inception of the model, if there is any, affect the overall effectiveness and efficacy of the model?
That's a very good question. Yes. So, yes, you're exactly right. The model itself is emotionless. So when we are building the portfolios, rebalancing the portfolios, there's no kind of portfolio manager override. There's no emotional element of it. We trade according to the algorithm. But you're quite right. The individual investor themselves, they have their emotions. They're going through their emotions every day. And one way they can use that, they can express those emotions is, taking money out of their account, putting money into their account. Maybe I can explain a little bit about our experience running Theo over the last 6 years here. Is two things, I think. One is investors, in our experience, gradually do get better at controlling their emotions. A lot of of our clients, when they come into MYTHEO, this is their first experience of investing. So it's natural to feel emotional about your portfolio, to look at it every day on the app and see where it's going. It's very natural to do that. We tend to see that, those kind of emotional reactions, pulling money out when the market falls, things like that, those tend to happen with investors who've been with us for, say, a year, maybe 18 months or so. Gradually, as they gradually get used to market volatility, they see that when the market falls, it comes back. When the market rises, it falls back. Long run, it keeps going up. But people get used to that, and they get better at controlling their emotions. So people do get better through time. The most common mistake that we tend to see is when the market falls sharply. Most people realize that selling is a bad thing to do. So most of our clients don't sell when the market falls sharply. And that's a good thing. But what we do see is inexperienced investors, once the market gets back to where they initially came in, once they get back to like a flat return, then they give up and say, "Oh, I can't take any more risk," and get out. Well, that's better than selling right at the bottom, certainly. It's better than that. But obviously, if you've lived through that, if you've lived through that volatility, you've been patient for that. Then selling just as you get back to zero is a terrible waste, I think. We do tend to see those kind of reactions, especially, as I said, with the investors who've only been with us for, say, like a year, perhaps 2 years, something like that.
Well, I think I learned a lot from this question, this sharing that you gave. Well, when I first invest in robo-advisor, I also look at it every day. Well, but I think after the last over the last 6 months, I haven't been looking at it. It's gradually, I've been looking at it lesser and lesser, because I do aware that the strategy is very consistent, and we have rebalancing every day, every month. So it does feel very comfort, to remain invested and focus on the other things in life. So so that's I think a very good sharing. Okay, so I think we are also in cognizance of the time. We may want to ask. I probably want to ask you just one last question. I say this as a hypothetical question, but I've actually been asked quite a lot on this. Where let's say if you're a young investor, right? Is it okay to be 100% into stocks?
Yes. I've had that question several times myself as well. The answer is yes. like yes, but maybe if I just explain, this is what MYTHEO would give, for example, a client who is 25 years old, has relatively little current assets, has a high risk tolerance, and has a long investment horizon. This is what MYTHEO would recommend to a client like that. And this is 83% equity. So 83% equity, and then a little bit of income and a little bit of inflation hedge. And that's what MYTHEO would recommend to a client like that. And so that's not that different from going, 100% equities. And you can choose to do that, obviously, within MYTHEO. So from that point of view, it's not a particularly extreme asset allocation.
Right.
So in that sense, the answer is yes, that's perfectly okay. And the growth portfolio is built to be perfectly okay to hold as a standalone portfolio, to put all of your money in. That's perfectly okay. But I would say, you've got to remember that going 100% equities exposes you to the kind of risk we've been talking about now, 50% drawdown in Lehman, that kind of thing. So you've got to really understand that, something like that could very well happen. And if it does happen, that's not the end of the world. The market will come back after that. But being 100% in equities means you've got to realize that you've got to, you may well have to live through something like a Lehman shock or something like that. And so you have to be confident that you can control your emotions such that when your value of your portfolio falls by 50%, you're not going to pull your money out.
You mentioned that the growth portfolio invests in different countries, geographical area. So is there like a limit, in terms of the country exposure that we built in the growth portfolio?
Thank you. Yes. That's a very good question. Yes. And so this gets to this idea of concentration risk. And so the answer is yes, we do put limits on all of the countries in the portfolio so that our allocation to those countries can't get too concentrated. The limit varies country by country, and it's really based on the overall size of the market in that country. And so what we tend to do is we look at the overall size of the market in that country, and then we set a kind of an upper and lower bound either side of that. And so that means that, the allocation to that country is going to be roughly proportional to the size of the market. But it means that, you're not going to get, 50% of your portfolio in, I don't know, allocated to Brazil or something like that. That simply won't happen.
Sure. So I think this answer relates to the question that this participant asked, or perhaps if you can just add maybe some points, if let's say I were to miss out that question. How does MYTHEO optimize the asset allocation? Set algorithm by management? Does MYTHEO foresee any positive value growth in China tech ETF? Example, the Crane Share KWEB.
There's several questions in there, right? So let's say, okay. So the asset allocation is driven by an algorithm that we built ourselves and we've been using for a long time. That algorithm is very stable, and so market movements won't trigger a big change in your asset allocation. We do update that algorithm every year with market data, and that leads to a small change in your allocation. But that allocation tends to be really quite stable. The allocation obviously will change through time. One of the inputs to the algorithm is your age. Obviously, as you get older, your risk tolerance changes, and so your asset allocation will change, but it changes very, very slowly year by year. So the answer to the first part of the question is, yes, the allocation does change, but it changes very slowly. It doesn't trigger large shifts in your asset allocation. The second part of your question to do with China. So just to be clear, China is part of our investment universe. And so within our growth portfolio, we have a large cap China, FXI is the ETF, a large cap China ETF in there. And then also kind of broader China exposure. Obviously, we have a Hong Kong ETF in there as well. We don't have the Crane shares one that you mentioned, but we do have China exposure, and we treat it just like any other market in the portfolio. So we do have exposure to China. I don't have a particular view on the China market. There are certainly commentators out there who say, certainly relative to, say, the US, China market is relatively cheap, and I think that may well be true. We do have an allocation to China, and it's simply driven off our investment model. We don't have a particular view in terms of timing the China market.
Sure. Okay, so if I can just wrap up. So the key takeaway, thanks Matt for sharing. The key takeaway for tonight's webinar is so it's difficult in the short term to predict the volatility of the portfolio. To prevent the portfolio volatility through diversification. Diversification is more about achieving a certain amount of investment security and safety over the long term. And diversification does not mean that your investment is protected from all losses. After all, it is impossible to eliminate risk completely. And when done right, diversification can help to reduce risks and the magnitude of losses, allowing investors to stay the course against short-term market fluctuation and continue to accumulate their wealth over long term to achieve their investment objective. MYTHEO automatically built a diversified portfolio that is tailored to your investment needs. And MYTHEO take the emotion out of investing. When the market swings, so do our emotions. However, using advanced algorithm, MYTHEO can help you stay disciplined, stay the course, and achieve your objective. So that concludes the session for tonight. Thank you for your patience and thank you for your participation. Everyone, thanks Matt for your sharing, and we'll see all of you again, hopefully next webinar next month. Thank you. Have a good evening.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.